Hey dreamers, when you start your investment journey, it can be confusing to decide where and how to actually buy and hold the dividend stock. I actually keep learning new things every day as an experienced investor. Do you know how much stock you're allowed to contribute in each place per year? And just what are some of the pros and cons of holding stock in different locations? In other videos, we talk about asset allocation, but in this video, I'll talk about the differences in asset location and cover where I hold my stocks, how I got there, and the pros and cons I've learned from holding investments in 401ks, IRAs, and taxable accounts. At the end, I'll cover the light bulb moment for me on individual accounts. Okay, so here's where I'm at, and the market's been up and down all over the place today. So at present time, I'm at 1.591795, and that breaks down into taxable accounts that total 803,756, and retirement accounts that total $788,039. So I certainly didn't plan it this way, but I'm right at 50-50 as of right now. And one way to get bearing on this is from a time frame perspective. So you might remember this graph from my net worth video. And in 2012, I was making enough to open and start to fund a traditional IRA. And in 2015, I opened a SEP IRA. And finally, in 2016, I opened an individual account. So I'm going to cover those types of accounts that I've had in my investing lifetime. So let's start with your work account, your 401k or 403b. Workers who are younger than age 50 can contribute a maximum of $20,500 to a 401k in 2022. That's up $1,000 from the limit of $19,500 in 2021. Now, if you're age 50 or older, you can add an extra $6,500 per year in catch-up contributions, bringing your total 401k contributions for 2022 to $27,000 if you're age 50 or older. Contributions to a 401k are generally due by the end of the calendar year, whereas IRA contributions can be made all the way up to tax day in mid-April for the previous year. So what are some of the pros and cons? Well, the pro is it's pre-tax contributions that come right out of your check. And usually the company has a match, so it's really worth doing. The con is that usually you have to choose from a predetermined list of mutual funds, ETFs, and bonds that have already been chosen by your retirement plan administrator. That means that a major con for a dividend stock investor like me, who also hates fees, is that you may not be able to hold individual stocks in this type of an account. Now, it does seem like there's a rise in self-directed 401ks. So if you're interested in this option, you might want to do a little research or ask your HR or plan provider if this is an option to find out more. Now, it might surprise you that I don't have a 401k at this time. Wait, what? The reason is because for the past few years, I've been doing gigs working for myself. And basically, I have a rollover IRA that has consolidated all the dead and gone past 401ks from previous jobs. So let's go there next. The rollover IRA. This is your choice after you leave a job. A rollover IRA is an account that allows you to move funds from your previous employer-sponsored retirement plan to an IRA. With an IRA rollover, you can preserve the tax-deferred status of your 401k retirement assets without paying current taxes or early withdrawal penalties at the time of that transfer. It's easy to do if you want it. You just call up your brokerage where you have your 401k and have them walk you through the steps of opening up a rollover IRA and transferring the funds. Some of the pros are, by rolling your 401k money into an IRA, you'll avoid immediate taxes and your retirement savings will continue to grow tax deferred. Another pro is you can start to choose individual dividend stocks, or really anything you want, bonds, CDs, whatever's on the open market. A con is that you might lose access to specific investment choices that your employer's plan has. So that might be something to look at. Another con is you can't just contribute to this account in the future. It's only for past 401ks. So you'll need to open different IRA type accounts if you want to continue to add to it, which brings us to the traditional and Roth accounts. Now, this is where things get a little more complicated, but basically, let's say you're several years into your working career and you're starting to make a little more money. You've maxed out your pre-tax 401k or 403b, whichever you have. The next step to up the ante is to continue to add investments through opening a traditional or Roth IRA. The main choice between a traditional and Roth IRA, and the biggest difference, and fork in the road, is how much do you make? Because the ability to make Roth IRA contributions is phased out for workers who earn more than 129k as an individual and 204k as a married couple in 2022. With a Roth, you contribute after-tax dollars. Then your money grows tax-free, and you can generally make tax and penalty-free withdrawals after age 59 and a half. One key disadvantage is that the Roth IRA contributions are made with after-tax money, and there's no tax deduction in the year of the contribution. And my understanding is another drawback is that withdrawals of accounts must not be made before at least 5 years have passed after that first contribution. So remember, I'm not a tax advisor, so I would want you to consult your brokerage and tax advisor for more details, but that's what I understand about a Roth. Now, with a traditional IRA, you can contribute pre or after tax dollars. Then your money grows tax deferred, and withdrawals are taxed as current income after age 59 and a half. Now, I'm not going to get into the particulars of a backdoor Roth conversion because that's a whole nother conversation. But for now, I'm still in a traditional IRA. So if you do a traditional like me, bottom line, the pros are that additional $6,000 more you'll be able to invest every single year, in addition to your 401k. Another pro is that $6,000 will be tax deductible until you reach $78,000K as an individual and $129K as a married couple filing jointly in 2022. But even without this, it's still a place where once in there, your investments will be able to invest tax-free until the retirement age of 59 and a half. So what's the con? Well, you can only do $6K a year. So I have a traditional IRA from those years of $6K contributions every year when I was working a regular 9 to 5. And now I have a SEP IRA, which I started in 2015. So let's talk about the SEP IRA. When I started making my own money on the side, I decided to open a SEP primarily because you could make more contributions per year. Contributions in a SEP IRA is the lesser of 25% of your total income or $61,000 for 2022. And that's up from $58,000 in 2021 and $57,000 in 2020. This has really been a game changer for me. It has allowed me to catch up on a lot of those years in college when I wasn't making anything. If you do work for yourself, you can also ask a tax advisor or brokerage consultant about a solo 401k. That's just another option with different rules to consider. As for the SEP, a pro is you can contribute a lot per year. Another pro is you can invest in anything, just like the rollover, traditional, or Roth IRA. It's total freedom. A con is it's only available if you make your own money. So if you're working a 9 to 5, you can't do it. Another con is, like all of those retirement accounts, if you wanted to take some of that money out, you're subject to that 10% early withdrawal penalty, which leads me to the individual, where I currently hold 50% of my money. So there was a moment in time when a light bulb went off for me, and it was in 2016. I was building up my cash and not wanting to spend it. I had paid down some of my mortgage and refinanced. I was starting to max out my SEP, and I was wondering what else to do with my money. Let me be clear. Nowhere and no one had ever said to me, hey, your investments don't have to be just in non-taxable retirement accounts. You can keep going and open an individual taxable account. Guys, we need to start normalizing the idea of talking about money and investments so that we can share more of the secrets to success. Because I was like, say what? So here's the deal. What is a personal non-retirement investment account? It's a way to invest money outside of a retirement account without using a bank account, such as a savings, checkings, or CD. You can open a stock investment account with pretty much nothing. $50, $100, fund your account, and then start placing trades through the trade platform, just like in the retirement accounts. There's no restrictions on income. There's no annual limits, and anyone can do this. So some of the pros, you can keep on investing, no limits. Another pro is you can take the money out at any time. It's not subject to any penalties before 59 and a half. So that 10% penalty just goes away. A con is you will get taxed on the dividends and capital gains. Another con is you don't want to be buying and selling up a storm in this account. You want to do that in your retirement account so you don't incur all the kinds of fees and time-consuming filing when it comes to tax time. And you might want to have a tax preparer help you come tax time. So there's another fee to consider. So to wrap up, think about it. On half of my money, I can at any time turn off the DRIP, the automated reinvestment, and it instantly becomes a side hustle income source for me with no penalties. Right now, my taxable accounts pay me approximately $40,000 a year. So once you start to get closer to being financially independent, it kind of makes you rethink where you want to hold your money. If you decide you really want to retire early and you want to rely on this income source. One last note, on all of these accounts, you cannot transfer monies between the accounts willy-nilly because the retirement accounts all have legal yearly contribution limits. So you need to treat them like walled gardens and plan accordingly. Something to remember always. So with that, in summary, it's helpful to know all of the types of accounts so you can be thinking about what your strategy is going to be and what your situation allows in terms of legal limits. I hope these insights and some of the pros and cons of where to hold dividend stocks was helpful. Okay, guys, thanks for watching. As always, I encourage you to do your own research and keep learning. And the disclaimer, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.